Good morning and welcome everyone to the Money Control live stream. Well, the Fed has played the role of party police to the script, Santo.
Party pooper is more like it, right?
I mean, police, pooper, either way, the party seems to be struggling at this point of time. Clearly, curbing the enthusiasm that the market had shown over the past 2.5 weeks. If you look at the Fed yesterday, they raised interest rates 75 basis points as was expected. But what really caught the market was by surprise is the revision upwards in the dot plot or the expected or projected rate hikes that the Fed is looking at. Now they're penciling in another 100 basis point rate hike by the end of this year, Santo, which was much higher than what the market was expecting earlier. And at this point of time, yesterday traders have already started penciling in a 75 basis point rate hike again for the fourth consecutive time in the next meeting, that is November, and another 50 basis point rate hike at the meeting in December. Clearly, the Fed is going hammer and tilt at inflation, and it is now willing to bet that even probably bet the economy on it, in the sense that the Chairman Powell indicated that restrictive policy or restrictive policy for longer could be the recipe to bring inflation down to their target of about 2%. And I think, Santo, what bulls will be really worried about going ahead is this phrase that Mr. Powell said, restrictive for longer. I think that is something that would scare them a little bit, because that would mean that even going into 2023, we could continue to see rate hikes, and that could have the impact of probably triggering a very, possibly deep, but at this point of time, maybe a shallow recession in the US economy and the global economy as well.
Well, CJ, it's no secret really that the Fed is not really happy with the way the market has been moving.
Yeah.
Rising stock prices always makes Fed's task so much more difficult, and of late we had been seeing that traders have been taking on the Fed and in fact getting away with it, and that becomes a bit of a problem for the Fed as well. Now that said, CJ, back home, how are Indian investors going to look at this thing? I would feel that the relative outperformance story still seems to hold true for the time being. The same thing that we've been saying over the last many weeks now, that Indian macro fundamentals are much better. But that said, outperformance does not necessarily mean that we'll continue to
you could outperform by falling as well.
Falling less than what. So that is also very much possible. But that said, liquidity alone, at this point in time, it's brute liquidity that's continuing to drive prices higher. But now valuations slowly are creeping into the picture, and we'll get a taste of it when we see the second quarter numbers. That will be something to watch out for, given that the overall global mood has changed quite a bit. Now, if numbers are just about middling, then probably I think investors may want to wonder whether they should be paying such high valuations.
Well, Santo, as an eternal optimist, I think the only thing that I could really feel good about from the yesterday's monetary policy is the fact that the Fed also seemed quite optimistic that growth in the US economy is probably more stronger than they had actually thought it would be, especially when you look at the job market. And as far as India is concerned, clearly our economy is quite resilient at this point of time. Yes, we have seen downgrades coming in across from private sector economists, multilateral organizations. They have all downgraded our GDP growth rate, but it's still among the highest out there in the world. And at this point of time, investors will continue to look for outperformance, relative outperformance, not absolute, but relative outperformance going ahead. I mean, a good indicator of that is the fact that the S&P 500 is down almost 15 to 20% for this year, whereas our market is higher by more than 5%. So clearly, there is a lot going in favor of India at this point of time, Santo. And I would expect that any sort of correction in this market, if it were to come in, if we were to see a decent correction after this monetary policy, I think that would be an opportunity for a lot of bargain hunters out there to lap up the stocks who had probably missed out in the previous rally.
Well, buy on dips has worked so far. Who knows, maybe it will work for
some more time.
That is
true. And I mean, if you look at it from a technical point of view also, Santo, I think the 17,700 is what we took support at yesterday. But even if that breaks, I think 17,300 would be the next indicator, the next support level for the market. And if that breaks, then of course we have to defend the 16,900 mark if we want to have any chance of climbing or scaling those record highs probably by the end of this year.
Let me jog your memory a little bit. We have corrected also up till 15,100 all the way when nobody saw it coming. Well, that said, what's the market looking like?
Well, it's looking weak, Santo. It's a day of red today. If you look at the SGX Nifty, it's indicating almost a 80 to 100 point cut at this point of time. Clearly, Wall Street ended, although it was volatile during the meeting, ultimately it ended on a lower note after that Fed rate hike. And if you look at Asian markets also today, Asian markets have started off on a very, very weak foot. Most of the Asian markets are down about 1.5 to 2% as we speak. What really interested me, Santo, is the US 2-year bond yield now at a 15-year high of around 4.12%. I mean, basically, an entire generation has not seen these sort of interest rates being offered. And I just sometimes wonder, what will be the the conservative foreign investor thinking. He has been pushed into the far flungs of the market, of the global market, to chase returns because he was not getting it in the bond market in US, which used to be the traditional instrument. Now that those bond markets are offering 4%, 3.5% return, why would you want to take that extra risk? And that is something that we will have to see how that evolves as far as the FI psyche is concerned. Also, oil prices, good for us that oil prices also weakened, probably expecting that a recession would hurt demand going ahead.
Well, market here has been still showing a fair bit of resilience, and probably liquidity could help keep it that way. Although there are little signs of trouble also, CJ, which we shouldn't be really overlooking at this point. I think Wipro deciding to sack 300 employees for moonlighting sends out a very clear signal. It till some time back
that
you were
stuck
saying,
in 2000.
yeah, no, till some time back you were seeing IT companies going all out to woo.
Yeah.
Woo employees because there was such a shortage of talent. Order flows were pretty strong. Now I think what could probably have changed is that maybe they don't feel the need to mollycoddle
Yeah, I mean,
employees
the
so much.
bargaining power has shifted.
Has
The
clearly
tables have
shifted, and
turned as far
probably
as
to some
bargaining
extent
power
that
is
could do
concerned.
with also the outlook on business. It's not that IT companies would not have been aware of what was going on, but for a long time they may have decided to turn a blind eye to it. That's one part. That's the second part is that if there is weakness in the global economy, at some point it's going to feed in through the trade channels. And our export sectors are likely to feel the pinch, textiles, IT, and also remember locally too, interest rates are going up, purchasing power is also taking a hit. These are all factors at this point in time. Because market is rising, nobody is really talking about it, but over time these will add up, so one needs to be cautious.
Yeah, we will have to see what the corporate commentary is, Santo. Clearly, that is the only indicator that the market really has, because given the fact that we do not have that many high frequency indicators or data points to really gauge where demand is at or the labor market is at. Although anecdotally speaking, everybody has been talking about that the lower strata of the consumer economy is clearly still struggling and trying to get out of the pandemic's woes. So it will be very interesting to see next month when the earnings season kicks in again for the second quarter, what sort of commentary we hear from the management.
And with that, let's quickly get a dive into stocks. Borosil Renewables. Now, this company is likely to be one of the big beneficiaries of the government approval for the 19,500 crore PLI scheme for manufacturing solar photovoltaic cells. Now, Borosil Renewables clearly is one of the market leaders here, and I would say this is one of the silent compounders. The stock was going really dirt cheap back in 2030, and there was a reason for that. That changed in 2017 when the government started imposing anti-dumping duties, and that's where Borosil Renewables fortunes took off in a big way. Last 3 or 4 years, huge growth in its earnings, and now it's probably the only manufacturer of solar glass in the country. So that gives it a strong edge at this point in time, and it's looking to expand its capacity through brownfield expansion. And the good part, according to HDFC Securities, is it has managed to get into long-term contracts for soda ash and natural gas at least till December. So not much pressure on the margin scene at least till December. Well, there are some other niggling worries, no doubt. Competition is getting intense, but at this time, the market, after a big sell-off which saw the stock come off sharply, it's showing signs of stability, and probably it's building for the next upswing.
Well, Santo, fundamentally, yes, there is a lot to like about Borosil Renewables, and this has been one of those stocks that has really caught investors' attention in that 2020-2021 rally. But I think if you look at it technically, clearly, the charts at this point of time are not indicating that optimism. I mean, the stock is at this point of time lagging below its 50-day as well as the 200-day moving average. So clearly indicating that there is a lack of interest among investors at this point of time. They are not willing to bet on the stock, given that it has fallen off a cliff after hitting a 52-week high back in April 2022. It has fallen considerably off those highs. And yesterday, when the news came out, Santo, and of course the news was out there in the market much before we had the official statement coming in. the delivery volumes were not that great. I mean, if you look at the delivery volumes for yesterday, they were actually in fact lower than the day prior to that, and this is despite the stock actually rising quite considerably in yesterday's trade. So that goes to show that strong hands are still missing on this counter, and does not elicit that much confidence that the gains that we have seen yesterday will likely continue in the coming days. Then the next stock on my radar today is one of the two technical picks I have is KPIT Technology. Now, of course, there is a fundamental news. I'll get to that, but before that, if you look at KPIT's technical chart, Santo, clearly it is showing a strong uptrend again taking place at this point of time. Prabhudas Leeladhar has indicated that the RSI has seen a very interesting bullish trend reversal, and therefore is portending more gains in the coming days. They're expecting almost a 10.5% rally in the stock in the coming days and weeks. So that is an interesting side from a technical point of view. From a fundamental point of view, well, the company has gone out and acquired Technica ENG GmbH, clearly a company that they feel could add to their revenue profile. The revenues of Technica are almost close to 20-25% of current annual revenues of KPIT Technology, which clearly could easily boost the company's revenue profile going ahead. And I think probably given that organic growth might be slowing down at this point of time because of the recession fears and whatnot, the company has explored the inorganic route to probably boost its revenue profile going ahead. Also, KPIT, do not forget, is a proxy play on the EV cycle that everybody has been so excited about, and I think this is one stock that market would want to look at later today.
Well, two quick counterpoints there, CJ. One is that it's got a significantly high exposure to the auto sector, and globally that's turning out to be a bit of a problem. As you said yesterday, Ford had cautioned against, had warned of continuing shortages in semiconductors, which could hurt demand. So that is one negative, and the other one is that both FIs and domestic institutions have trimmed exposure to the stock during the June quarter. Well, next stock on my watch list is Heritage Foods. The stock has been seeing a good run up over the last month or so, but again, I think, CJ, the enthusiasm seems to be a little misplaced if you just look at the margin profile of the company. There has been consistent pressure, and it has come down all the way to about barely about 2.5% from what it used to be about 8-7%. That's a steep reduction there very clearly. This despite the fact that the company managed to increase its revenues, but the higher revenues are clearly coming at lower profitability. Now, the management has said that it is planning to increase the share of value-added products. Now, right now, it earns about 65% of its revenues from milk and rest from value-added products, and that is going to be the key challenge. And unless the management gets its act right there, we could see the pressure on margins continuing, and that's why I would be a little skeptical about the recent run-up in the stock price.
I think, Santo, the recent run-up had largely been on the back that Amul not so long ago had raised prices for milk products. I think clearly the market was expecting that other companies will also follow through, and therefore that could probably aid their profitability a little bit. I think milk procurement prices also have remained quite sort of stable, so that probably is something that the market is looking at. But I feel that in the mid-cap space, if you're playing in that space, clearly there are better opportunities out there than Heritage Foods. You need not put yourself through the earnings and stock volatility that that comes along with being an investor in Heritage Foods at this point of time. So probably another bet that even I would probably steer clear of, because I just don't see that the risk that you would take merits the reward that you will probably get at this point of time. Well, the next stock on my radar and the last stock on my radar today is Tata Communications. If you look at the chart of the stock, recently the stock had taken a breakout from about 1100 odd levels, and which basically a lot of technical analysts believe could be a beginning or commencement of a new uptrend on the stock. Clearly, the RSI, if you look at the daily RSI as well, there has been a bullish reversal pattern, Santo, and a lot of technical analysts, especially those out of Prabhudas Leeladhar, are indicating that this could probably sustain in the coming days and portend more gains for the for the stock. Overall, Prabhudas is looking at about 13% gains in the stock in the coming days. Apart from that, of course, Tata Communication would be a major beneficiary, Santo, of the enterprise market in the telecom space. Clearly, Tata Communication along with Bharti Airtel are two major players at this point of time, and I think there is a lot of optimism that Tata Communications could continue to benefit from that in the coming years.
Well, a quick look on the market. It's just opened, and as expected, a near 400-point cut on the Sensex and close to 100-point cut on the Nifty as well. Advances to declines ratio is negative in early trade. Close to about 1,000 stocks are down over the previous close, while about 760 are up. Nifty Bank is also under pressure, down
Yes, Santo.
0.5%.
But if you look at, again, the story continues of outperformance of the broad market with the Nifty Mid Cap and Nifty Small Cap Index only falling 0.3% and 0.2%, which basically, reflects on the argument that buy India at this point of time. Buy any company, not any company, but buy companies which are largely focused on the domestic economy. Probably ignore those who are largely focused on the global economy. And I think that is clearly playing out even at this point of time. If you look at the India VIX, that has surged about 3%, sitting at around 19.23. And sectorally, almost all the indices are in the red at this point of time. So a weak start, but not as weak probably as we have seen in some of the global markets today.
Well, and with that, the last stock on our watch list this morning, Canfin Homes. Now, CJ, we discussed this stock the day before. Stock has been under pressure ever since Girish Kousgi's resignation. Kousgi was MD and CEO of the company. Now, the sentiment for the stock had taken a beating in May when it came to light that about 37 accounts, there were frauds in 37 accounts of Canfin. Since then, the stock has made a good comeback, but now again the abrupt departure is raising many questions, and you're seeing a sharp increase in short positions. Yesterday, open interest in the futures went up by close to about 24%. Now, one is that there has been a consistent improvement in asset quality as well as profitability. Now, that's hard to dispute at this point in time. The second is that the build-up of short position does make it look like some kind of a strategic bet at this point in time. If things were to look up, you'll suddenly see a flurry of short covering, which could then push the stock higher.
I think, Santo, clearly the cloud of uncertainty surrounds Canfin Homes and will probably continue to surround Canfin Homes till the time that they appoint a new CEO. We will have to wait and see whether that's a internal candidate, or as Jeffrey suggested, that if an external candidate were to come in, that would be a better thing for the company. Overall, I think there is some merit for consolidation in the stock, given that it had seen a decent run up prior to this this announcement coming in of the CEO's resignation. I think speaking to market, the view I got, Santo, is that a lot of people feel that at this point of time the stock will remain in a sell on rise sort of mode, that any sort of comeback or a pullback on the counter could be utilized as an opportunity to book profits if we have been buying or have been participating in the stock over the past couple of months. But incrementally, I think it is better to wait it out, see who the new CEO is, see what his strategy is, whether there is any sort of skeletons in the closet that probably may come out once the new CEO comes in. I think that would be probably a better way to go about Canfin Homes than to plunge in any correction at this point of time.
Well, with that, it's a wrap on this edition of Markets with Santo and CJ. Thanks for watching, and do remember to share your feedback in the comment section below.
And as usual, guys, keep following us on the social media links that you can see at the bottom of your screen. And for the rest of your financial news, stay tuned to moneycontrol.com and download the Money Control app. We'll catch you again live at 3 p.m. Till then, have a great trading day.